righty, Bill, kick us off.
Welcome to the new Barbarians podcast, where we mash up markets and economics to deliver actionable insights to our community.
Each week, we break down the macro trends, market events, and investment opportunities shaping the financial landscape, from traditional markets to the emergent opportunity in digital assets.
And everything in between, including my specialty, using AI tools to drive the investment process. Just two Wall Street veterans dropping the Bloomberg for the blockchain.
Whether you're an investor, trader, or just someone trying to navigate the chaos, we've got you covered. The old financial system is shrinking, so we are here to help you understand the expanding opportunities in digital assets.
So hit that subscribe button, follow us on your favorite podcast platform, and let's cut through the noise together. Welcome back, everyone, to the new Barbarians podcast. As discussed on Monday's episode, today I'm actually going to present a discussion generated by two AI individuals who are discussing a recent paper I published on SSRN on advanced portfolio optimization techniques. So this is a pretty dense topic. And, you know, in terms of quantitative portfolio theory, I did try and go pretty deep. Hopefully the hosts of this podcast will make it a little bit more accessible to our audience rather than my 50-page paper that is, you know, fairly technical. And hopefully you enjoy it. But if you aren't interested in, you know, super technical quantitative portfolio theory, please feel free to skip this episode. And we will continue trying to do more of this in the future if people enjoy it. Thanks a lot.
Welcome back, everybody, for another deep dive. This time, we're going to be diving into the world of modern portfolio construction and optimization techniques. You've probably heard of the classic models like modern portfolio theory, but we're going to see how things have evolved. From those classic models into the cutting-edge world of machine learning and artificial intelligence. Specifically, two key methods that are being used a lot by quant funds these days, thematic model grouping and consolidated alpha optimization and Tamara. Our guide for this journey is going to be a really fascinating research paper by Harmonicue Insights. It's called Portfolio Construction Evolution from Models to Machine Learning, and it's really interesting because it aims to bridge that gap between academic theory and what's actually happening in the real world. So I'm joined by an expert in the field who can help us break down this paper and really understand the nitty-gritty. Welcome to the show.
Thanks for having me.
So maybe we can start off by laying the foundation here, when we talk about portfolio optimization, we can't really avoid talking about modern portfolio theory or MPT. Our listeners are probably pretty familiar with it, but just to make sure we're all on the same page, can you give us a quick recap of what MPT is all about and why it's so important?
Yeah, absolutely. So MPT, really kind of revolutionized the way we think about investing. Before MPT, investors focused almost entirely on, maximizing returns. But MPT introduced this idea that volatility, what we often call risk, is just as important. It basically showed us that investors should be looking for the best possible return for a given level of risk. And that's how we get to the idea of risk-adjusted returns.
And that's where this concept of the ancient frontier comes in, right?
Yeah.
That set of portfolios offering the highest expected return for each level of risk.
Exactly. That's the holy grail of MPT, finding that sweet spot on the efficient frontier.
But I have a feeling that in the real world, things aren't quite as simple as just plotting a few points on a graph and calling it a day right.
Yeah, MPT in theory is very elegant, but in practice it can be quite challenging to actually implement. One of the biggest hurdles is accurately estimating parameters like expected returns and the covariance matrix, which measures how different assets move together. And of course, MPT doesn't always account for real world constraints like transaction costs or position limits.
So basically, MPT is a great starting point, a really important framework. but it's not the whole story. And the paper actually mentions newer models like Black-Litterman and techniques like shrinkage estimators that help address some of those limitations.
Yeah, those are some great examples of how people have built upon the foundation of MPT. For example, Black-Litterman is super useful because it lets investors incorporate their own unique views and beliefs into the optimization process, making it a lot more personalized. And shrinkage estimators, well, they try to improve the estimation of that covariance matrix we talked about, making it more staying unreliable.
So we're kind of adding layers of sophistication, trying to get a more realistic and robust approach to portfolio optimization.
Yeah.
And this is where those two main approaches that we mentioned earlier come into play: thematic model grouping and consolidated alpha optimization. So let's start with the model-based approach. What's the basic philosophy there?
Well, you can think of it as taking diversification to the next level. Instead of just having one big portfolio, you're essentially creating multiple smaller portfolios, each with its own distinct theme or strategy.
So it's almost like a portfolio of portfolios, right?
Exactly. And the idea is that by carefully selecting themes that are based on different factors or models, you can further reduce risk and potentially enhance returns.
What kind of themes are we talking about here? Can you give us some examples?
Sure. So the themes could be based on all sorts of things. Broad economic trends like inflation or interest rates, specific sectors like technology or healthcare, geographical regions like emerging markets, or you can even have themes based on different types of data like sentiment analysis or social media trends.
So you're essentially slicing and dicing the investment universe in different ways and then creating specialized portfolios for each slice.
That's a great way to put it. And because each of these themes is typically constructed to be uncorrelated, or at least have low correlation with each other, the overall portfolio ends up being much more diversified than if you just had one big pot of assets.
That makes sense. So if one theme hits a rough patch, it's less likely to drag down the entire portfolio.
Right. It's all about spreading that risk and building that resilience.
Now, the paper mentioned that these model-based portfolios can be particularly effective in niche markets or specialized sectors.
Yeah, that's a key advantage. They really shine when you have a strong conviction about a particular theme or area of the market.
So let's say, for example, I have a hunch that the renewable energy sector is going to explode in the next few years.
Well, in that case, you could create a thematic model specifically focused on companies developing or utilizing renewable energy technologies.
Right.
Or let's say you're bullish on a specific emerging market. You could create a model dedicated to investing in companies operating in that region.
So you're essentially creating these focused bets based on your specific insights or outlook.
Exactly. And the beauty of this approach is that you're not limited to just picking stocks. You can use whatever assets or instruments make sense for that particular theme.
So it's a very flexible and customizable approach.
Absolutely.
Now, apart from that diversification benefit, what are some of the other advantages of this model-based approach?
Well, another key advantage is that performance attribution is very clear-cut. If your renewable energy theme outperforms, you know exactly which model contributed to that success. And if it underperforms well, you know where to focus your attention for improvement.
So it's very transparent. You can see what's working and what's not.
Right. And there's also a clear economic interpretation behind each theme. You can easily understand the logic and rationale for why you chose to include it in your overall portfolio.
That makes a lot of sense. So you're not just relying on a black box. You have a clear narrative for your investment decisions.
Exactly.
But let's be honest. No approach is perfect. So what are some of the potential downsides or challenges associated with this model-based approach?
You're right. There are always trade-offs. One potential pitfall is overfitting. This happens when a model is too closely tailored to past data, and it might not perform as well when faced with new unseen data.
So it's like studying for an exam, but only memorizing the answers to the practice questions.
Yeah, that's a great analogy. You might ace those specific questions, but you won't really have learned the underlying concepts.
So how do you prevent overfitting in the context of portfolio construction?
Well, that's where robust testing and validation techniques come in. We'll delve into those a bit later. But in addition to overfitting, another challenge is understanding how those different themes or models will interact with each other. Sometimes these interactions can be quite complex and opaque, making it difficult to predict exactly how they'll impact the overall portfolio performance.
So you're constantly trying to strike that balance between diversification and the potential for unintended consequences from those complex interactions.
Precise.
And is there anything else we should be aware of when considering this model-based approach?
Well, while it's easy to see how each individual theme performs, pinpointing the exact factors that are driving that performance within a theme can be a bit tricky. You know, a particular theme is doing well, but understanding the nuances of why can be challenging.
So it's like knowing that your car is running smoothly, but not necessarily understanding all the intricate mechanics under the hood.
Exactly.
Okay, so we've got a good overview of the model-based approach, its strengths, its weaknesses. Now let's switch gears and talk about that other method, the consolidated alpha approach. What's the main idea behind that one?
So consolidated alpha takes a very different route. Instead of creating these separate thematic portfolios, it aims to build one single unified portfolio that incorporates all the available alpha signals from all those different models you've built.
So it's like combining all your best ideas, all your secret ingredients into one super portfolio.
Exactly. You're not compartmentalizing different themes. You're throwing them all into the mix and letting the optimization process sort things out.
That sounds pretty ambitious. How does that actually work in practice?
Well, the first step is to gather as many predictive features or signals as you can. Anything that you think might give you an edge in the market. This could include fundamental data sentiment analysis, technical indicators, you name it, and then use a technique called mean variance optimization to determine the optimal allocation for all those signals within that single portfolio.
So you're basically letting the math do the heavy lifting, figuring out how to best combine all those different signals.
Right. And the beauty of this approach is that it's incredibly comprehensive in its use of signals. You're not leaving any potential alpha on the table.
So you're really trying to squeeze every bit of performance out of those signals.
Exactly. And another advantage is that monetizing those signals, actually turning them into profits, becomes very transparent. You can directly see how each signal contributes to the overall portfolio's performance.
And that makes performance attribution a lot easier as well.
Absolutely. You know exactly which signals are working and which ones aren't.
That level of transparency must be very appealing, especially for those who like to understand the why behind their investments.
Oh, for sure. It takes away a lot of that guesswork.
Now, the paper also mentioned that these consolidated alpha portfolios are particularly good at capturing something called cross-sectional information.
Yes, that's an important point.
What exactly does that mean?
Well, it means that this approach is very good at picking up on those subtle patterns and relationships across a wide range of assets. So, for example, if certain sectors are performing well while others are struggling, the consolidated alpha approach, by considering signals from all those different areas, can potentially adapt more effectively to those shifting dynamics.
So it's like having a more holistic view of the market, a wider lens.
Exactly. And that can be a huge advantage in today's fast-paced and interconnected world.
But I'm guessing this approach also has its own set of challenges and trade-offs. What are some of the potential downsides we should be aware of?
Well, one of the biggest concerns is signal dilution. When you combine so many signals, there's a risk that some of them might cancel each other out, or their individual impact might be weakened.
So it's like adding too many spices to a dish.
Yeah.
You might end up with a muddled flavor.
Yeah, that's a good analogy. Too much of a good thing can sometimes be a bad thing.
What other downsides should we keep in mind?
Another challenge is that the optimization process for a consolidated alpha portfolio can get very complex very quickly. It requires a lot of computational power and sophisticated techniques to manage all those signals effectively.
So you need the right tools and expertise to really make this approach work.
Right. And perhaps less tangibly, you lose some of that thematic clarity that you get with the model-based approach. It becomes harder to tell a clear story about why you're invested in certain assets.
So you're trading off some of that narrative and interpretability for the potential for higher returns.
Yeah, it's a trade-off for sure.
Okay, so we have these two very different approaches to portfolio construction, each with its own set of strengths and weaknesses. But ultimately, the question is, how do they actually perform in the real world? Let's move on and take a look at the empirical evidence and see what the data tells us.
Sounds good. Let's dive in.
Okay, so let's get down to the nitty-gritty. How do these approaches actually perform out in the wild? Let's start with those model-based portfolios. What does the data tell us?
One common measure of risk-adjusted returns is the Sharpe ratio. And when you look at Sharpe ratios, model-based portfolios show a lot of promise, especially particularly when applied to specific sectors or niche markets. We typically see Sharpe ratio improvements of like 0.3 to 0.5 in targeted strategies like those renewable energy and emerging market examples we talked about earlier. But what's even more impressive, I think, is how those portfolios performed during like a really volatile period, like the 2008 financial crisis.
Oh, yeah, that's a great point. I mean, everybody remembers 2008. It was a crazy time. So how did these model-based portfolios fare during that kind of market meltdown?
They held up remarkably well, especially when you compare them to broader market strategies. Remember how we were talking about how their themes are designed to be uncorrelated? When one sector, like, say, financials was plummeting, the others, like healthcare or technology, weren't dragged down as much, that diversification really helped to cushion the blow and mitigate those losses.
So it's not just about chasing higher returns, it's also about building that resilience for those inevitable market downturns. Kind of like having shock absorbers for your portfolio.
Exactly. And that inherent diversification also plays a role in signal preservation. There's research that suggests that model-based approaches do a better job of maintaining the strength of those individual signals over time. Compared to strategies that just kind of lump all those signals together. This is probably because they're isolating those signals within those specific themes, preventing them from being diluted or washed out by other potentially conflicting signals.
So each signal gets to shine in its own little spotlight instead of getting lost in the crowd. That makes sense. Okay, so we've seen the model-based approach in action. Now let's turn our attention to consolidated alpha. What kind of performance are we looking at there?
Consolidated alpha portfolios tend to have higher information ratios.
Information ratios. Now, I know that might sound like jargon to some of our listeners, so can you explain what exactly that means and why it's important?
Sure, it's essentially a measure of how consistently a portfolio manager can generate returns above their benchmark relative to the amount of risk they're taking. So it helps to distinguish between skill and luck.
Okay, so a high information ratio is a good thing. It's a sign that the manager is actually skilled and not just getting lucky.
Right.
What else does the data reveal about these consolidated alpha portfolios?
Well, they also tend to be quite effective at navigating those complex market environments that we were talking about earlier.
Yeah.
You know, when things get a little bit messy, they often outperform those broader strategies during those periods. And that's because they're drawing on a much wider range of signals, allowing them to kind of pick up on those subtle patterns and adapt to those changing market conditions.
So it's like having a more sensitive radar for spotting opportunities across the market. That agility must be really valuable in today's fast-paced investment environment.
Exactly. And let's not forget about the practical aspects. Consolidated alpha portfolios often stand out in terms of operational efficiency. They tend to excel at managing transaction costs, optimizing portfolio capacity, and just kind of streamlining that overall investment process.
So less paperwork, fewer headaches for the portfolio manager.
Exactly, making their lives a little bit easier.
But I am curious, given the complexity of managing all those signals in one portfolio, how do these consolidated alpha approaches handle risk management?
That's where their sophistication really comes into play. They excel at controlling what we call factor exposures, meaning they can very precisely target their desired levels of exposure to different types of market risk. They utilize techniques like factor tilting and risk parity to really fine-tune their exposure to specific risks.
So they're not just throwing darts at a board, they're very strategically managing their risk.
Absolutely. It's a very deliberate and calculated process.
Which makes sense given how many moving parts there are.
Okay, so we've got these two very different approaches, each with its own set of advantages. It seems like the choice between them really boils down to your specific goals and your risk tolerance as an investor. But I'm curious, just from a pure risk perspective, how do their profiles compare?
That's a really important consideration. Model-based portfolios, they tend to offer those superior diversification benefits. Because remember, those underlying themes are designed to be relatively uncorrelated. It creates a portfolio that's inherently more stable, especially during those market transitions or periods of high uncertainty. So the model-based approach is like the steady Eddie, slow and steady wins the race kind of investor.
Yeah, that's a good analogy.
What about consolidated alpha? How do they approach risk?
Consolidated alpha portfolios are more about efficient use of risk and, those sophisticated risk management techniques we were talking about. They're more dynamically adjusting their risk allocation, employing those advanced risk assessment tools, and making those more calculated bets.
Okay, so it's diversification versus maximizing risk-adjusted returns, two very different paths to potential success.
Right.
But let's be realistic, no approach is perfect. There's no free lunch in investing. What are some of the limitations and challenges that both of these methods face?
You're absolutely right. There's no magic bullet. One challenge that both approaches face is the risk of overfitting, where those models become too tailored to that past data and they struggle to generalize to those new market conditions. And implementation constraints like, computational complexity and data quality issues, those can also be significant hurdles.
So it's not just about choosing the right approach, it's about executing it effectively and being mindful of those potential pitfalls.
Absolutely.
It's like having a great recipe but using stale ingredients.
Exactly. Now, in terms of specific limitations, the model-based approach sometimes struggles with scalability. As you add more and more themes, it can become increasingly difficult to manage all that complexity and the interactions between those different models.
So it's tough to keep all those plates spinning.
Yeah, and going back to your earlier question, there's also the risk of missing out on opportunities that don't fit neatly into any of your predefined themes.
You might be so focused on your existing themes that you completely miss out on a new emerging trend.
That's right. Now, shifting to the consolidated alpha approach, the big concern there is signal dilution. When you combine so many signals, some of them inevitably get drowned out by the noise, or their individual impact is just weakened.
It's like trying to listen to a symphony, but all you hear is this cacophony of instruments.
Yeah, it becomes hard to distinguish the individual melodies.
So it's all about striking that balance between leveraging as much information as possible without getting bogged down by the complexity or sacrificing the effectiveness of those individual signals.
Exactly. It's a delicate balancing act.
And that leads us to a crucial point that the paper emphasizes the need for continuous refinement and adaptation.
Right. Neither of these approaches is a static, one-size-fits-all solution.
Right.
The investment landscape is constantly evolving, and our methods need to keep pace.
So what does this all mean for the future of portfolio management? What are the key research directions that will really shape the field in the years to come?
Yeah, so we've talked about the challenges, but what about the exciting opportunities? What's on the horizon for portfolio management? The paper highlights 3 key areas where I think we'll see a lot of exciting development. First, there's a growing need for more granular data and more advanced statistical methods. High frequency data, alternative data sources maybe social media sentiment or other unconventional sources, and information that captures a wider range of market regimes. It's not just about having more data, it's about having the right kind of data and the right tools to make sense of it all.
That makes sense. We're in this age of information overload, so being able to sift through all that noise and find the valuable nuggets is absolutely crucial. What about the second direction? What's happening there?
It's all about improving out-of-sample testing methodologies. We need to make sure that these models we're building actually perform well in the real world, not just on historical data. So we need to develop more sophisticated testing frameworks that can account for those dynamic market regimes. Structural breaks, those non-stationary conditions we were talking about earlier.
So it's not enough to just back test. We need to really stress test these models to see if they can handle the unexpected.
Exactly.
Okay, so that's data and testing. What's the third research direction?
This one is maybe the most exciting. It's the exploration of these hybrid optimization approaches, where we're combining the best aspects of different methods like machine learning, traditional optimization techniques, hierarchical clustering, to create these really robust and adaptable investment strategies.
So taking the best tools from different toolboxes and building something truly customized and powerful.
Exactly.
Do you have any concrete examples of how this might work in practice?
Sure. Imagine using machine learning to identify those promising alpha signals, right? And you can take those signals and feed them into a traditional mean variance optimization framework to determine the optimal allocation. And then you could use hierarchical clustering to manage the risk and ensure diversification across those different signals.
So it's almost like building this multi-layered, more intelligent approach to portfolio construction. It sounds like we're moving towards a future where portfolio management is even more data-driven, technologically advanced, and responsive to those ever-changing market conditions. Almost like these portfolios are becoming more alive in a way.
Yeah, I like that analogy. It's really capturing that sense of dynamism and adaptability.
Well, I think this deep dive has been incredibly insightful. We started with those foundations of modern portfolio theory, unpack those 2 really powerful approaches to portfolio construction, examine their performance, and even got a glimpse into the future of the field.
Yeah, it's been a great discussion.
I think for our listeners out there, what we've learned today should really help them understand the complexities and the nuances of this world of modern portfolio management. It's about asking those critical questions, challenging those assumptions, and really embracing the evolution of this incredibly dynamic field.
Couldn't have said it better myself.
And as we wrap up this deep dive, I want to leave our listeners with one final thought to ponder. Given the evolution of these techniques and this call for these hybrid approaches, what does this suggest about the future of portfolio management? How is technology going to continue to shape those investment strategies? Until next time, keep exploring, keep learning, and keep diving deep.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.